But that moment is not a celebration. It's a warning. Because when silver breaks 100, the market doesn't speed up. It slows down. It locks up. And the reason has nothing to do with hype, and everything to do with how fragile the system underneath this market really is. Right now, the screens still look calm. Charts are moving, prices are updating, trades are being printed. But beneath that surface, something very different is happening. Liquidity is thinning, credit is tightening. And the mechanism that moves silver from the ground to refiners, to wholesalers, to investors is starting to seize. When silver breaks $100, the market doesn't fail loudly. It fails quietly. And most people don't notice until it's too late. Welcome to the Silent Ledger. If you want calm, clear analysis without the noise, make sure you like this video and subscribe. It helps this channel stay visible, and it helps this research reach people who are trying to understand what's really happening, not just react to headlines. Here's the uncomfortable truth. The silver market was never designed for triple-digit prices. It was built for cheap metal, cheap credit, and constant turnover. For decades, silver lived in a range where banks could control it, wholesalers could finance it easily, and industrial users could treat it like an ordinary input. The entire structure assumes silver stays manageable, predictable, boring. Once that assumption breaks, the system starts to behave in very strange ways. At $100, silver stops behaving like a commodity and starts behaving like money again, and money behaves very differently under stress. The first thing that breaks is not supply, it's financing. Wholesalers do not buy silver with cash sitting in a checking account. They rely on revolving credit lines from banks. Those credit lines are fixed in dollars, not ounces. That detail matters more than most people realize. When silver was $20, a $10 million credit line could finance 500,000 ounces. Inventory moved smoothly. Shelves stayed stocked. But at $100, that same credit line only finances 100,000 ounces. The purchasing power of the wholesaler collapses overnight. Not because demand changed, not because silver disappeared, but because the price rose faster than the banking system was willing to adapt. This is where the freeze begins. Wholesalers hit their credit limits. Banks hesitate to extend terms. Interest rates rise. Hedging costs explode. Suddenly, even profitable firms are forced to slow down or stop buying altogether. Not because they don't want silver, but because they can't carry it on their balance sheets anymore. At that point, the market doesn't clear through price. It clears through rationing. You'll hear people say, if silver is so scarce, why isn't the price higher? That question assumes the market is still functioning normally. It isn't. When markets freeze, price becomes a suggestion, not a signal. Trades don't disappear because silver is unwanted. They disappear because credit has failed. This is how shortages hide in plain sight. At the same time, futures markets send a completely different message. Contracts still trade, volume still prints, but futures are promises, not metal. When prices rise too quickly, short positions bleed cash. Margin requirements rise. Banks and funds are forced to cover, not because they believe in silver, but because they fear holding risk over a weekend, over a headline, over a geopolitical shock they can't control. That's why $100 matters psychologically, not just technically. It changes behavior. Short sellers stop pressing. Long buyers become cautious. Everyone becomes defensive. Nobody wants to be the one caught needing physical metal when the market decides to stop offering it. And here's the paradox. As price rises, liquidity falls. Higher prices do not attract more sellers. They scare them away. If you own physical silver outright, with no debt, no margin, no counterparty, you don't rush to sell at 100. You hesitate. You wait. You wonder what the next reset looks like. That hesitation removes metal from circulation, even as demand grows. This is why premiums explode at the exact moment paper prices suggest abundance. The disconnect widens. Online listings disappear. Delivery times stretch. Buy buttons turn into wait lists. Not because silver vanished, but because nobody wants to part with it while the rules are changing. The industrial side feels this pressure immediately. Manufacturers need certainty. They need predictable supply at predictable prices. A frozen market offers neither. When volatility spikes and financing tightens, industrial buyers pull back or lock in what they can. That creates competition between investment demand and industrial demand, and history shows that investment demand always wins during monetary stress. At that point, silver stops flowing freely. It starts flowing selectively. Large buyers with cash get priority, small buyers get delays. Dealers stop quoting firm prices. The market becomes opaque. This is what a freeze actually looks like. No alarms, no sirens, just silence. This is also when the public gets confused. People see high prices and assume profits everywhere. But behind the scenes, middlemen are struggling. Some are forced to dump inventory just to raise cash. Others refuse to buy at all. You see anomalies. Discounts where they shouldn't exist. Premiums where logic says they shouldn't. That's not manipulation. That's stress. The market is revealing its plumbing, and the plumbing was never built for this pressure. Gold plays a role here too. When gold pushes toward major psychological levels, it validates the entire precious metals complex. It sends a message that currency risk is rising, that debt is being questioned, that trust is eroding. Silver amplifies that message. It's smaller. It's thinner. It moves faster. When gold whispers, silver shouts. It marks the transition from price discovery to trust discovery. From trading to hoarding. From speculation to protection. This is the phase where people stop asking, "What's the price?" and start asking, "Can I get it?" And those are very different markets. If you're still watching, this is the point where it helps to pause and think long-term. Not about tomorrow's candle. Not about next week's pullback. But about what kind of system you want exposure to when credit tightens, when supply chains strain, and when confidence becomes more valuable than yield. If this analysis is helping you think clearly, leave a comment and share it with someone who's still assuming this is just another cycle. Because history is very clear on one thing: monetary transitions are not orderly. They don't announce themselves politely. They reveal themselves through stress, through freezes, through moments when markets stop behaving the way textbooks say they should. Silver at $100 is not expensive, it's expressive. It's telling you that the old assumptions no longer hold. That leverage has limits. That paper claims are not the same as physical ownership. That speed and efficiency break down under pressure. The question isn't whether volatility will increase. It already has. The question is who is positioned to sit through it calmly and who is forced to react. At the Silent Ledger, we focus on understanding systems before they break, not explaining them after. This isn't about fear, it's about clarity. Knowing why markets freeze allows you to stop expecting them to behave normally. As this move develops, expect confusion, expect mixed signals, expect moments where prices fall even as fundamentals tighten. That's how stressed systems behave. They shake out weak hands before repricing reality. The people who struggle the most are those who think in straight lines. The people who do best are those who understand that markets are social systems built on trust, and trust disappears faster than supply. When silver breaks 100, the market freezes not because there isn't enough metal, but because there isn't enough confidence. Confidence in credit, confidence in settlement, confidence in promises, and once that confidence cracks, it doesn't come back easily. If you've made it this far, you already see what most don't. If you think this perspective adds value, leave your thoughts below and share this video. It helps surface serious conversations in a space crowded with noise. The next phase won't be loud at first, it will be quiet. Listings gone, delays normal, volatility accepted. That silence is the signal. Stay grounded, stay observant, and stay with the Silent Ledger.